Good afternoon. I'm Jeffrey Halley and welcome to BizTech's Asian Midday Market Watch on May the 6th. My co-host today is Samantha Voon and our guest is Phan V. Leung, founder and CIO of Track Record Trading Academy in Singapore. V, thanks so much for coming on the show today.
It's good to be here. Let's talk about markets.
Excellent. Won't mess around. So let's have a look around then, as we normally do, at the price action in Asia today on local stock markets. It's a Japan and South Korean holiday today, but China is back after a long break. So if we look at the Shanghai, it looks like it is playing a little bit of catch up 1.05% today. The Hang Seng is almost unchanged at just up 0.05%. The S&P ASX 200 down in Australia is up 0.67%, while Singapore's STI is up just 0.26%. Bringing up the rear is the Kuala Lumpur KLSE, rising just 0.32% today. V, what do you make of the price action today? Are these holidays in Korea and Tokyo, South Korea and Tokyo having an impact?
Well, I guess it's a much quieter day because the major centers are out. But this positive price action is just a follow through from Friday's market reaction to the much weaker than expected US non-farm payrolls. The jobs number was a touch weaker than expected, and that increased the likelihood of interest rate cuts this year from the US Federal Reserve. So we saw the US stock markets rallying more than 1% on the day, and we are just seeing the follow through in the Asian markets today.
Right. We also saw the ISM services PMI slump to 49.4. That was a pretty shocking number. And also the business activity in the same data set really retreated aggressively as well. I can see why equities have moved higher on the expectations now that the Fed may have to cut rates this year. But what is your outlook for the US economy here? It's a bit of a mixed picture at the moment.
Well, I think it's a bit tough to predict the US economy. It's been confounding skeptics for the longest time. It's been strong for the longest time. But I think finally we are seeing the economy slowing because of higher interest rates for quite some time now. Right? And we are seeing the highest interest rates in years. And the Fed has been keeping it at this level for some time. And we're starting to see it filter through the whole economy. And I think U.S. Federal Reserve Chair Powell was very dovish last week after their policy meeting. And he was very insistent on remaining dovish. He did not take any of the baited questions where the journalists were trying to bait him into saying something hawkish, talking about interest rate hikes if possible, but he avoided all that. And I guess now we know why, because the jobs market is slowing and it's slowing considerably. And just be reminded, the US Federal Reserve have dual mandates. One is to keep inflation under control towards their 2% target, and also full employment, right? And recently, as recent as last week, they said that the risk towards the dual mandate is much more balanced than before. So that means they are more focused on jobs and more focused on the labor market. And I think what we are seeing is the natural consequence of two years of high interest rates. Yeah.
Mm-hmm.
So let's talk about China. China's Caixin Services PMI has remained in expansionary territory at 52.5 today. Do you think the worst is over for China?
Yeah, I think price action wise too. If you look at the Chinese stock markets as well as the Hong Kong stock markets, the indices are starting to move up, moving above recent resistances on the charts. And it's been a long time coming. I think pretty much everybody that you speak to and I speak to, they're all bearish China now. And that's kind of the story of the China economy, right? When the whole world is bearish, the economy they start to come back. And I think the Chinese government is very resolute in boosting the economy. So it's good that we are starting to see some follow through, some real some real reaction to the policies that they've implemented so far. And I think what is important is that if it should falter from here going forward, I think we'll see more policies from the government. So yeah, I think we are likely to have seen the bottom in the Chinese economy, unless of course, I guess everything is very dependent on the political situation, the geopolitical situation in the world. We do have the U.S. presidential elections coming up towards the end of the year, so it's very likely that the political debate will center around how do we treat China as a strategic ally or rival, right? And I think the politicians will likely start to turn the screws on Chinese policies again. But I think the Chinese economy has been suffering for a long time. I think the recovery is way overdue.
Okay, staying on geopolitics for a moment, President Xi of China has actually landed in France today for a diplomatic tour. Now, I know for a fact from his New Zealand trip, he is a fan of red burgundies, and I'm sure he'll be trying some of those while he's over there. But are you expecting anything major to occur geopolitics / policy-wise from President Xi's trip to France?
Well, I think I would not have any insight into what's likely to happen. I think there's only very few people in the world who knows exactly what he's planning to do. But any engagement is good. It's good that he's making the visit, and it's likely that they will talk about various issues, including the situation in Ukraine, as well as the semiconductor chips ban from the US on restrictions on China. I think they'll talk a lot about possible engagement going forward and trade. It's good that they are talking. What are the likely outcomes? I think if they are going to talk, it's likely that they're going to be trying to get some policies, some deals done. So that's a good result for us. I think it's better that we live in a world where the world leaders are engaging with each other rather than closing down and engaging in xenophobic policies without really talking to each other. So it's a good outcome, but we don't know what's going to be the result. But it's a step in the long journey to for the world to accept China as a major player.
And B, let's talk about Bitcoin, right? So Bitcoin fell sharply last week, hitting 56,000 briefly before rallying up, and now it is at 63,000. Should we be more cautious on Bitcoin going forward? What do you think?
Well, I think in the scheme of things, of course, the numbers are big now that it's in the tens of thousands, but percentage-wise, the volatility is very well contained within expectations of what happens in the crypto world. What we saw last week was I guess it's the usual buy on rumors, sell on fact kind of reaction, where the world was talking all about like anybody with a journalistic platform was talking about the Bitcoin halving, right? As if it's like the best thing since sliced bread for Bitcoin. But it is with Telegraph, it is. I think there were maybe the price action has shown there's a lot of short-term punters that were looking for a rally because of that halving. But halving happens as planned, and there was no sharp reaction to the upside. So I guess there's disappointment, there's liquidations and all. But Bitcoin, if you ask me, and this has always been my view on all the programs that we've done together, is that it's a long-term hold. It's a buy on dips, and the adoption for Bitcoin continues to grow. We saw Hong Kong implementing, approving, and launching Bitcoin ETFs. That's the first step in many other steps that will engage and also onboard more investors into cryptocurrencies. So should we be cautious? I think, well, if you are trading on leverage, yes, always be cautious. But if you're not trading on leverage, I think a certain percentage of your savings should be allocated to Bitcoin. It is going to continue to go higher. The adoption is going to grow. There's more and more people going to be invested, and if you are not yet invested, I think you're running the risk of being the last person around to be invested in the years ahead.
Okay. I just want to ask one more question, and I just can't help myself here, V. Dollar yen. Now, there's been a lot of speculation that the Bank of Japan, on behalf of the Ministry of Finance, has been intervening to sell dollar yen over the last week, although no one has actually stuck their hand up yet and said, yes, we have. Even Janet Yellen today, I think, was fairly circumspect about the dollar yen. Surprisingly, the carry trade, such as Kiwi yen, Kiwi dollars held up very well in this whole dollar yen sell-off. But what is your outlook for dollar yen here? We're still a long way above the 100 and 200-day moving averages, but should we expect more choppy range trading, or should we be more cautious on this one-way dollar yen trade at these levels now?
So dollar yen, well, it's well known in the FX trading community that dollar yen is the widow maker. And it's a little bit hard to trade dollar yen in the short term, if you're relying on the authorities to help you, because they are pretty inconsistent in their messaging and their actions. But I think what we saw last week was resolute intervention. It's estimated to be more than $60 billion, and that's already as much as is close to what they intervened in 2022. In the late 2022, there was about $62 billion, and the price action shows that they are quite insistent that it doesn't break above 160. Around the high 150s, they are coming in to sell aggressively, and they did it during the first intervention was on a Tokyo holiday on Monday, and the second was towards the end of the Wednesday trading afternoon in New York. So at all hours, yes, they're watching the markets now, and they are quite adamant in signaling to the market that they do not want persistent yen weakening and with a high volatility basis. Of course, the intervention efforts are adding to the short-term volatility. What has happened since Friday is also a little bit confusing in that it seemed like a weak non-farm payrolls, a weak US job number, and much lower US bond yields would have caused dollar yen to go lower. Instead, we saw buying on dips by local investors. But I guess they are just covering their short positions, which was initiated on the back of BOJ intervention. I think going forward, it will be hard pressed for dollar yen to break above 160 because of two reasons. One is the resolute intervention by the Ministry of Finance. The other thing is that we are seeing a weakening in US jobs numbers, and that is going to increase the likelihood of Fed officials talking about interest rate cuts going forward. And if we do see more weak economic numbers from the US, I think the likelihood of an interest rate cuts in the US will grow, and that should weigh on US dollars, especially against the yen, because market positioning in the longer run, in the medium-term positioning sector, I think most speculators are still very long dollar yen because, as you said, it's a good carry trade. It's been doing well for some time. So there's no reason for them to liquidate as yet. I think if we get below 150, we should see a spate of liquidations, and that should likely take it much lower levels, and especially if it's accompanied by much lower US bond yields.
Right, great stuff. V, thanks so much for coming on the show today. Always brilliant having you on.
It's good, thank you.
We've been speaking to Phan V. Leung, founder and CIO of the Track Record Trading Academy in Singapore, on BizTech's Asian Midday Market Watch. I'm Jeffrey Halley.
And I'm Samantha Woon.
And this program will be available on our website, www.biztech.asia, as well as our social media platforms. You can also catch it on our syndication partners, TV stations, radio stations, and websites. Thanks so much for tuning in today.